So we're going to go straight in with chapter 1, which is the fundamental principles of insurance. So we use the term risk for a variety of different things. It can be either your work or your personal, Danielle. It doesn't matter, whatever's easiest for you.
Thank you.
So, no worries. So the way that we use the term risk in insurance, through a number of different ways. So if you're an underwriter, you might refer to the thing that you're insuring as the risk. You might ask if something's on risk, or it could be, you know, the risk of something happening. But typically the definition of risk is that possibility of something unfortunate happening. If there's any doubt concerning how a situation is going to end, some sort of unpredictability, the possibility of a loss. But remember, there's also a chance of a gain as well. Now, we'll look at that in respect of insurance and whether that kind of situation is insurable. We call insurance a risk transfer mechanism. And what that means is that as consumers, even ourselves, we want to pass the risks that we have onto somebody else. So I drop my phone all the time and I don't want to pay for it. So I will pass that risk onto my insurer so that if that does happen, they're going to pay for it for me. And that's a risk transfer mechanism. You pay a premium and transfer the risk of the loss to the insurers. And what insurers do with those premiums is they take all the premiums of the many and collect them into something called a common pool. And I like to think of this as like a swimming pool full of money. And this is where all of the premiums go in. And remember, not everyone will pay the same premium. Even if they have a similar risk, they're only going to pay a premium that's equitable, and that just means fair. Okay, so they might have different factors, which means they pay more. You know, they might be a careless driver, might be a good driver. You might have the same car, but you'll pay a little bit different based on the risk that you present to that common pool, because all of the claims are also coming out of that pool. So the insurers want to make sure that you're paying enough in to cover your claims, because people who are worse risks have got more chance that they're going to take money out of that pool. So it's only fair that they pay more in. We all have different attitudes to risk as well. We have people who are risk seekers, happily throw themselves out of a plane. I would not do that. I would prefer to stay on ground. So insurers also have this as well. So insurers have their own risk appetites. They have specific risks that they like to write. They have specific risks that they prefer to swerve. And I'm sure that the insurers or brokers that you work for have this as well, the things that you like to write and the things you're a bit more cautious of. And there's ways that we can manage risks as well. So the concept of risk management is a key focus across many companies. And there's 3 aspects which make up risk management. So we've got the identification of risks. This is where we figure out what it is that's posing the risk. We've got the risk analysis, and then we look at controlling the risk finally to try and minimize or even eliminate the risk entirely. Now, when we look at controlling risks or eliminating risks, we can do that through 2 different controls. So the first one is through a physical control. So this could be putting an alarm on your house or putting a lock on your door. These are things that we can physically do. And the second way is through financial controls. So this is purchasing an insurance policy, for example. This is just ensuring that there's some sort of backup if something does go wrong. Okay. Now, I'll always point out particular things in these sessions which could be useful for your exam. So you'll hear me mention it throughout, like always a couple of things you should know, or you probably will get asked a question on this. So just look out for those. But these are 2 bodies that can help insurers with their risk management controls that you should probably know about. We've got the BRE, the Building Research Establishment They look at the built environment. They offer training and guidance on building materials and construction, so they can help insurers. And we also have the FPA, the Fire Protection Association. So this is the UK's National Fire Safety Organisation, and they give advice and training on fire control. Now, the components of risk, we've got 3. Yes, Ollie, yeah, they're there to help. Yeah, the insurers. And if you're a commercial customer as well, you can ask for advice. So we've got 3 main components of risk. And the first thing we're going to look at is that uncertainty. So underwriters, you know, we've not got crystal balls. We don't know what's going to happen. We don't know when it's going to happen, and we don't know how bad it's going to be if it does happen. So that's all about uncertainty. And then secondly, we've got the level of risk. So the frequency is how often something happens, and then we've got the severity, which is how bad or how severe will it be when it does happen. So for example, I went shopping in Aldi about 3 months ago. I came out of Aldi and I looked at my car over in the car park, and straight away I saw a dint in the side of my car, and it was really obvious that someone's trolley. I live in Manchester, the weather's always terrible, so it was probably really windy, and trolley just flew across the car park and dinged my car. Yeah, things like this happen all the time. People's wing mirrors get banged all the time. People get chips in their windscreens all the time. So something like this would be classed as a high frequency event, but low severity. Okay, so high frequency, these types of accidents happen all the time, but it's low severity because that dint's still in my car. I'm not going to claim for it. Probably won't cost very much, but it's not worth claiming, and it's just a thing, isn't it? It's low severity. It's not severe. It's not affecting a lot of people. It's not hurting anybody. And then on the other side of that, we've got things like plane crashes. So if we think about that, thankfully, you know, these don't happen very often. So they're very low frequency. But when they do happen, they cause a lot of damage to aircraft, to passengers, to property. So they're extremely severe. So this is low frequency, high severity. We could also have high frequency and high severity as well. So if we think about if you have hurricanes in a hurricane high risk area, we know that they happen all the time, and we know that when they do happen, they're really bad. But as a market, we can prepare for these types of events. We know when they're going to happen, and we typically know how much we're going to pay out in claims. So for underwriters to look at frequency and severity, it really helps them with managing risk and rating risks. Next, we've got perils and hazards. So a peril is the primary cause of a loss. So it's the fire, it's the flood, for example. And a hazard determines how the peril develops, and it influences the operation of it. So think about a thatched roof on a building, very flammable. If there's a fire in a building, that's the peril, remember. A thatched roof is directly going to change how that fire works. It's going to make it travel faster. So that's a bad hazard, yeah. So like I said, hazards can be good or bad, like the roof. And they can be split into physical hazards, so tangible things like the thatched roof, like the construction of a building. But we can also have something called moral hazards. And this relates to the characteristics and the behaviour of somebody. So is the insured dishonest? Are they a criminal? Do they have lots of driving convictions? And all of these things are going to be considered by an underwriter.